Tim Noonan, a lot of people get a magic number in mind when they're thinking about retirement, but you say that's not the best way. People should think about a funded ratio instead. What exactly is that?
Yeah, it's a great question. That's been a lot in the news these days, the so-called magic 4% distribution rate. 4% rule, recently has been revised to the 2.8% rule or revised up to the 5% rule. It's, kind of a debate about which number should you set and forget. And my view is you shouldn't set and forget any number, particularly when the consequences of setting and forgetting could be very, very dire indeed for the investor. So we like to focus on a thing that we call the funded ratio, which is essentially a construction that comes from the pension world. And a funded ratio really measures the relationship between assets and liabilities. How well does my nest egg line up against my expected future expenses? So our view, our encouragement for advisors is that they should try to explore with their clients whether or not their eyes are as big as their stomach. Do their assets ultimately line up to match their liabilities? That's what the funded ratio is all about.
Right now, it's so hard for retirees to make ends meet unless they're in the stock market, because typically a retiree should have their money in bonds or a fixed income product where they can get yield. There's no yield out there now, so how are you advising retirees to deal with that, considering the current circumstances?
Right. Well, the current circumstances are, of course, calling into question all kinds of conventional wisdom about how retirees should invest, including investing in bonds or have the same amount of bonds as your age or this type of thing. Because of the central bank activity all around the world, the stimulus that has encouraged the economic recovery has also run up stock prices, and this has created, of course, the final act for central banks, which is to put the stimulus genie back in the bottle with the rising of interest rates, which we expect to happen in the fall. So what we're advising our clients at Russell is to be globally diversified, maximum levels of diversification, and to balance the seeking yield and balance that with a total return approach, such that you're not grabbing so much yield today that it deprives the portfolio of its ability to grow enough for tomorrow.
And what about taxes? Even though you're in retirement, you still got to be tax efficient, right? So how are you counseling your advisors and your investors with regard to that?
Taxes are incredibly important. In fact, we've been spending a lot of energy at Russell putting tools into our advisors' hands that helps them to see the magnitude of the tax cost on their client's portfolio. For example, in the car on the way over to talk to you this morning, I was playing with that application and looking at a $500,000 nest egg that is invested over a 20-year period of time. After 20 years, the potential tax savings by moving to a more tax-effective approach is over the amount of the initial investment. It's $600,000 after 20 years. That buys an awful lot of long-term care.
All right. Well, thanks a lot for coming on, Tim.
My pleasure.
Thank you for watching The Street.